If you are new to the stock market, you are in the right place because in this video, I'm going to show you how you can use the stock market as a tool to accelerate your wealth and achieve financial freedom. The way I'm going to do that is by breaking this video up into 8 parts. I'm going to start by talking about number 1, why you want to invest in the stock market. Then number 2, how to actually buy stocks in the stock market. Number 3, how do you make money in the stock market. Number 4, what moves stocks to go up or down. Number 5, building a stock market strategy for yourself. Number 6, understanding the different types of funds that you can invest in as a stock market investor. Number 7, how do you analyze and value stocks to make smarter investment decisions? And number 8, how do you avoid some of the biggest mistakes as a stock market investor? So let's jump right in with number 1. Why should you invest in stocks in the first place? There are 2 reasons why you want to consider investing your money into stocks. Number 1 is it's time tested. Number 2 is it's proven the returns. The New York Stock Exchange has been around since 1792.
It is the New York Stock Exchange on Broad Street, America's greatest securities market that perhaps typifies the business of the Wall Street district. Stocks and bonds are bought and sold, and each transaction is carefully recorded to be communicated by telegraph, radio, and cable all over the world.
And the returns are there to back it up. Over the last 100 years, the stock market has grown by an average of 10.49% a year. But let's break this down to see how the stock market has grown over the last century. In 1925, the Dow Jones was trading at around 120 points. By 1955, the Dow Jones was trading at 442 points. By 1985, the Dow Jones was trading at 1,327 points. By 2015, the Dow Jones was trading at 17,500 points. And by 2025, the Dow Jones was trading at around 42,000 points. What we have seen throughout history is that the stock market goes up over the long term. Yes, we see market crashes happen. Yes, we see market downturns happen. Yes, we see recessions happen. But despite those downturns, if we look at the stock market over a long enough period of time, markets have continued to go up, and the belief is that markets will continue to go up. Not in a straight line. We will still see market crashes, we will still see market downturns, we will still see recessions, but over the long term, markets will continue to rise. This is what creates opportunity for you, because now you can also grow your wealth with the stock market by owning a small piece of it. But before I get into that, let's make sure we're on the same page of why the stock market exists. If I start a successful company called Jaspreet's Guac and I want to raise some money, that way I can grow my company even faster, I have 2 options. I can go to a bank or I can go to investors. When I go to a bank, I'm generally borrowing that money. And maybe banks don't want to lend me more money. Maybe I've already borrowed a lot of money. Maybe I don't want to borrow any more money from banks. The other option is I can go to investors and get money from them. Now, generally when I'm getting money from investors, for the purposes of this example, I'm not trying to go out and borrow money. I am giving them a piece of my company in exchange for ownership. So you as an investor give me money, I give you ownership in my company. So I take my company, Jaspreet's Guac, and I'm going to divide it up into 100 smaller pieces. Let's just assume that these are all smaller pieces. Each piece is called a share. And now I can sell you 1 share, 2 shares, 10 shares of my company in exchange for money. If, hypothetically, I sell each share for $10 and there are 100 shares of my company, I divide up my company into 100 shares, well, that means my company is valued at $1,000. 100 shares times $10 per share. Now, if I want to go out and raise money by selling my shares to investors, I can go out and find investors like you who want to actually buy my stock, or I can go to the public markets, called the stock market, and sell some of my shares over there. And the way that I do that is by doing an IPO. Initial public offering. And what that means is I'm going to take some of my shares. Let's assume that I'm going to take these shares right here and I'm going to sell them to the public markets. Now, anybody can now buy 1 share of my company and be an owner of my company. The nice thing about this, when I sell 30% of my company, is you get ownership of my company. You risk some of your money, and if my company does well, well then you will be rewarded with bigger profits. And for me, it's also good because now I'm getting that money. When you invest your money in my company, that money comes in my pocket. And sure, maybe I can take that money and go on a vacation, but even better is I can take that money and reinvest it back into the company and make this company grow even bigger, even faster, which makes the rest of my shares more valuable as well. That's why the stock market is such a great wealth building tool and how it works. But now you gotta understand, how do you actually buy stocks in the stock market? Remember, a company has to go through an IPO to be able to trade on the stock market. Not every company wants to trade on the stock market. Like Chick-fil-A is not on the stock market, so you can't invest in Chick-fil-A. That's called a private company. Other companies like McDonald's are publicly traded, which means anybody can buy and sell them. But how do you actually go about doing that? This is where you need a stock brokerage. Back in the day, you'd have to call somebody and they would execute these trades for you. It was a long and expensive process. Nowadays, you can just download something like Robinhood. Me personally, I like E-Trade, I like Schwab, and I like M1 for my passive investing. More on that in just a moment. And by the way, just for full transparency, I am not sponsored or anything by E-Trade or Schwab. I do have a partnership with M1, so if you want to use my affiliate link, I have that link for you down in the description. The 4 things you want to think about when you're creating a brokerage are fees, reputation, location, and type of account. Starting with fees. You don't want to overpay in fees. Shop around. If your brokerage is charging you really high fees and it's not worth it, then don't go with them. A lot of brokerages are completely free now. Number 2 is reputation. How big are they? How long have they been around? How reputable are they? Just do some Google searches. If they seem kind of sketchy, I wouldn't want to put my money there. Number 3 is location. Can you, based off of wherever you are in the world, invest through that brokerage? And number 4 is the type of account you want to create. Are you creating a retirement account like an IRA? Are you opening a self-directed account, meaning just a stock brokerage account for yourself? Make sure your brokerage will allow you to create the type of account that you want to. The second thing you want to think about when it comes to buying and selling a stock is when the markets are open. Because the markets are not open 24 hours a day like the cryptocurrency market. Generally, you can only buy and sell stocks between 9:30 a.m. Eastern Time and 4 p.m. Eastern Time. And yes, that's Monday through Friday, excluding holidays. And I've already mentioned this, but let's make it explicitly clear. You can only buy and sell shares of publicly traded companies. These are companies that have filed an IPO. You cannot buy and sell shares of private companies. Now that we've laid the foundation, let's get into the fun stuff. How do you actually make money as a stock market investor? And this is where I want to remind you that for those of you that are investors or want to become investors, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where we break down what's happening in things like the economy, stocks, housing, crypto, and the global markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning. Plus, when you join Market Briefs, you'll also get my investing masterclass, where I'll show you how you can get started as an investor and how you can find those hidden investment opportunities by taking advantage of market craziness. This masterclass and Market Briefs is completely free. So if you want to get the newsletter and the masterclass, all you have to do is click the link down in the description below. There are 2 ways you can get paid in the stock market: appreciation and dividends. Appreciation is when you buy a stock for $100 and it goes up to, let's say, $120. A dividend is when a company is paying you for doing nothing except owning that stock. They just deposit the money directly into your brokerage account. So let me show you how this plays out. In the year 2024, McDonald's started off the year trading at around $290 a share. By the end of the year 2024, the McDonald's stock had grown to $295 a share. So if you owned 1 share of McDonald's, your stock went up by $5. Now, that's not a huge gain, but it's still a gain. This is appreciation. McDonald's stock went up by a little bit. But you also have dividends, because over the year of 2024, McDonald's also issued a dividend which said that they gave every shareholder $7 a share. So you saw your stock go up by $5. But at the same time, McDonald's would have deposited $7 into your brokerage account just for owning 1 share of McDonald's. If you own 2 shares of McDonald's, they would have given you $14. If you owned 100 shares of McDonald's, you would have gotten $700, and on and on and on. $7 for every share that you get. But why does McDonald's pay out a dividend? Well, a dividend is a cash distribution that you get as an investor. And the reason why they do that is because companies like McDonald's have a lot of profits, and then they don't know what to do with this cash. So when a company has a lot of cash in their bank account at the end of the year, there's 3 things they can do. They can save that money for an emergency. They can reinvest it back into the company, or they can just give it away to shareholders, people like you. And ideally, you'd like to see companies do all three. They want to save some money for an emergency. You want to see them reinvest back into the company to keep growing and stay innovative. And then when they make these profits, you want to be rewarded as an investor. And one way that they can do that is just by giving it away to you as a shareholder, and you get your dividends for every share that you own. Now I get it, $7 might not seem like a lot, but when you do this for years and decades and you keep working to accumulate more shares, well, it can start to add up. For example, in 2024, Warren Buffett made $775 million in dividends just from his ownership in one stock, the Coca-Cola company. Now that you understand the different ways that you can make money in the stock market, let's get more granular to understand, why do stocks move up and down? At the end of the day, the prices of anything, whether stocks or real estate or gold, depends on supply and demand. When you have more sellers than buyers, if everybody's selling the McDonald's stock and nobody's buying it, the price is gonna fall. But if everybody wants to buy the McDonald's stock, you have more demand than supply. Well, that's going to push the prices of the McDonald's stock up, because now the buyers are going to fight against each other by bidding wars. And this is where you want to understand the factors that will impact supply and demand in the stock market. And the easier part to understand is supply, because this doesn't change as much. When a company lists the number of shares that they have, that's the amount of supply out there. It's a fixed number. If I divide up my company into 100 shares, that's the amount of supply that there is available to trade. But sometimes companies can change that. For example, Coca-Cola recently did a 10-for-1 stock split, meaning they increased the number of shares out there by tenfold. This doesn't mean that the value of their stock changed. It means the number of shares out there changed. So it kind of looks like this. If this was one share of the Coca-Cola stock, well, now you own the same thing, it's just divided up into smaller pieces. You now own 10 shares instead of one. Each share might be worth $1 as opposed to 10, but you have 10 shares as opposed to 1. So it's the same thing, it's just the number of shares are different. So we're not going to talk too much about supply, but let's talk about demand, starting from a macro level. The first thing that impacts the demand of stocks is inflation. What is inflation? It's when there's more dollars out there. When there's more dollars out there, people have more dollars in their pocket. And one of the things that you can do with more dollars is take the money and use it to buy stocks. So if there's more money going into the stock market, that's more demand, which can push stock prices up, which is why inflation generally benefits stocks. The second thing that can influence demand is growth of a company. Because if a company reports that they're growing their profits, that they're growing their market share, that they're growing their innovation, that then becomes more attractive to investors, because I might look at that and say, this company is becoming a lot better. They're making more money. They're growing a whole lot bigger. They're growing a whole lot faster. That growth makes it more interesting for me to want to go out and buy it, and that increased demand can then push that stock price up. But this is the part that I want you to pay attention to. Just because a company is making more money doesn't necessarily mean that a stock price is going to go up. Like we've seen many times where a company will grow their profits, but the stock price actually falls. That's why a stock's price isn't always directly correlated with their profitability. It's about supply and demand. It's about the investor's sentiment, the investor's emotion towards that stock. If a company's profit grows and investors get more excited about that growth, more investors buy, stocks go up. If a company sees smaller growth, they start to shrink, investors might be less interested, the stock price go down. But you can also see the opposite happen. If a company makes bigger profits, but investors are not excited about that company, they don't think that it's going to grow in the future, it might be making more money, but the stock price could fall. So at the end of the day, you have to understand supply and demand to understand where stock prices are moving, which brings us to number 5. How do you build a strategy for yourself as an investor? Now listen, I am not a financial advisor. I'm just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. The thing that you want to understand when it comes to investing your money is that personal finance is personal, and you got to know the right strategy for you. I break it down into 2 parts, into passive investing or active investing. Passive investing is what I call a set it and forget it strategy, where you set up a system where every week or every 2 weeks or every month, money is going to be pulled out of a checking account and invested. I'll show you where in just a moment, but it's going to be automatically invested and you don't have to worry about it. Active investing is for those of you that want to be a little bit more involved. You want to invest in individual companies. You want to do that research to understand where's the economy moving, which stocks could be growing in the future, what shifts are happening that you want to pay attention to. More work, more time, and you'd also be studying the financials, listening to earnings calls, and studying companies. This is not for everybody. This has more risk, but also more potential return. This has less risk, less time, less research, less potential return. You got to decide what's right for you. Again, I think most people should be passive investors, but for the some that want to be more involved, active investing can be a great strategy. I'm not talking about trading. I'm talking about just being more involved in which stocks that you actually invest in. This is one of the things that I teach in my investing masterclass. So as a passive investor, you're investing in funds. I'll explain what that means in just a minute. And this is a set it and forget it strategy. As an active investor, you're now going to invest in individual stocks. You're going to be investing in individual companies. This takes more work, more research, more time, but also more potential return. And with that, we've talked about the strategy. Let's talk about the different types of funds that you can invest in as a passive investor. There are three general types of funds that you can invest in as a passive investor. You can invest in index funds, ETFs, and mutual funds. They all work very similarly, that now you're investing in a basket of companies. Because now instead of investing in one company, like say Amazon, you're investing into a group of 500 companies or 1,000 companies or 2,000 companies, and you're not managing it yourself. The fund manager is doing the managing. All you have to do is just invest in the fund, and then they do all the work. But there are some slight nuances between index funds, ETFs, and mutual funds. That way you can pick the right type of investment for you. And let me break this down. There are three things you want to pay attention to: the fees, the number of trades you can make in a day, and the minimums that you need to actually go out and invest. With an index fund, the way that these work is that they're generally managed by a computer, an algorithm. And because of that, the fees are generally a lot lower because you're not paying for an expensive money manager. That means you can keep more money in the actual fund instead of making the money manager richer. When it comes to the number of times you can trade this a day, unlike a stock, which you can trade unlimited times a day, you can generally only buy and sell an index fund one time a day. And generally, yes, there are minimums in order to go out and invest into an index fund. I'll give you an example. VFIAX is the Vanguard Index Fund that gives the exposure to the S&P 500, meaning this is investing into the 500 largest companies in the stock market. Now, if we start with the fees, you'll see right here the expense ratio is listed at 0.04%. Again, this is an index fund, so you can only buy it or sell it once in a day. And you can see here the investment minimum is $3,000 to get started. We can compare that to a mutual fund, which are generally managed by an active money manager. So now, because you're paying for an actual person, your fees are generally a lot higher, but the goal is to get better returns. Unfortunately, we haven't always seen better returns in mutual funds. What we've seen is that generally over the long term, mutual funds don't always outperform index funds and ETFs after factoring in fees, but that doesn't mean it happens every single time. Then when we take a look at the number of trades that you can make in a day with a mutual fund, again, like an index fund, you can generally only trade in and out of a mutual fund once a day. And then when it comes to minimums, like an index fund, yes, there are generally minimums in order to invest into a mutual fund. Take a look. This is the T. Rowe Price Global Value Equity Mutual Fund. And if we start by taking a look at the expense ratio, this has an expense ratio of 1.09%. That's a whole lot higher than what we saw with the index fund, and in order to get started, you have to invest a minimum of $2,500. Then in the middle, we have this happy hybrid called ETFs, which stands for an exchange traded fund. And this one's interesting because when it comes to fees, they could be high or they could be low, because there are index fund type ETFs and mutual fund type ETFs, meaning there are passively managed ETFs and actively managed ETFs, so you just have to check. Then when it comes to how many times can you trade in and out of an ETF, it's unlimited, because you can buy and sell shares of ETFs like you can a stock right on your brokerage. And then when it comes to minimums, generally the answer is no. There's no minimum to get started when you invest in an ETF, minus whatever the cost of the ETF is, although many brokerages will allow you to invest in the ETF by buying a fractional share of it, so there's really no minimum that you need to get started with an ETF. Take a look. This is the S&P 500 ETF. This has a ticker symbol of SPY, SPY, and what you'll see is it has an expense ratio of 0.09%, so pretty low, and at the same time it says nothing about a minimum because there are no minimums for you to invest, and you can buy shares of SPY on really any brokerage. So now that you understand the different types of funds to invest in as a passive investor, index funds, ETFs, mutual funds, let's talk about the opposite. If you wanted to be an active investor, how do you analyze and value an individual stock? For the purposes of this example, let's take a look at the McDonald's stock and the Coca-Cola stock today. By the way, MCD is a ticker symbol of McDonald's, so if you wanted to buy one share of McDonald's, that's what you'd be buying. If you wanted to buy 1 share of Coca-Cola, you'd be buying that ticker symbol KO. That's what you'd enter into your brokerage. Now, at the time of me recording this video, McDonald's is trading for around $300 a share and Coca-Cola is trading for around $100 a share. And now if I were to ask you which one is a bigger and more valuable company, many people would say McDonald's because, well, their stock is more expensive than Coca-Cola. But that's the wrong analysis. Remember, the stock price, this share price, is the value of the company divided by the number of shares. McDonald's or Coca-Cola can change how many shares are out there, and that will then ultimately change the stock price. And this is where you want to take a look at the value of a company, which is called the market capitalization. Take a look. McDonald's has a market capitalization of around $220 billion, while Coca-Cola has a market capitalization right here of around $10 billion. So yeah, the McDonald's stock is trading about 3 times higher than the Coca-Cola stock, but that doesn't mean anything. What you want to pay attention to is the value of the company, because the McDonald's company is more than 20 times bigger than the Coca-Cola company at the time of me recording this video. But that still doesn't answer the question of what's a better investment? And this is where now your analysis will start as to where is a better place to invest your money, where you can see the best growth. And one question that you could ask is, for every dollar of profit, how much is the valuation going up? Because you want to take into account how valuably investors are looking at McDonald's profits versus Coca-Cola profits. And this is publicly available as well. One thing that you can take a look at is the P/E ratio, which shows how many times profit this company is being valued at. And if that's confusing, I'll explain exactly what that means, but take a look at this. McDonald's has a 27 times P/E ratio versus Coca-Cola has a 17 times P/E ratio. Now, to really understand what this means, let's assume that I have a hypothetical company that's making $100 of profit a year. If I'm making $100 of profit a year, how much is my company worth? Well, it depends. If my company is trading for 27 times earnings like McDonald's is, that means to take 27 times 100, my profit, which means my company would be valued at $2,700. But if my company had a 17 times multiple, now it takes 17 times 100, my profit, and now my company is worth $1,700. So just because a company has more profit doesn't necessarily mean it's going to be worth more, because you have to also understand this multiple, and this means that McDonald's is trading at a more expensive multiple than Coca-Cola is. Is it better or worse? Well, that's really ultimately up to you as the investor to decide what types of multiples make sense for you and which companies you think will have bigger growth potential. And this is where you want to think about, well, which companies should I be researching? And the simplest place to start is just look around and see what you're buying, what's around you. Are you buying Apple products or Google products? Are you shopping on Amazon or are you shopping at Walmart? This can give you a very nice initial way to start, but then if you really want to be more advanced, this is where you can start investing in your own research as an investor to pay attention to what shifts are happening in the economy. For example, my team at Briefs Pro publishes a weekly newsletter where we break down a market shift that we see happening, because we have a team of analysts that are studying the markets. They're traveling the country, they're going to trade shows, they're talking to industry experts, and they're looking to see what changes are happening in the economy and what industries could be seeing more money in the future, and we publish this into our pro reports. This is a paid report, this is a paid service. If that's something that you're interested in after you join Market Briefs, you can also learn more about Briefs Pro to see if there's something worthwhile for you to subscribe to. We have thousands of investors that have subscribed to Briefs Pro and really love the research and reports that we're publishing. But if you are interested in that more advanced research, you can check out Briefs Pro. That's what we do there. And now let's talk about which mistakes you should avoid. That way you can keep more of your money and hopefully grow your money a lot faster. Let's start with the basics. Stocks go up and stocks go down. Market crashes happen, recessions happen, and they're going to continue to happen. Every time you see a market downturn, people panic, they freak out, and then they lose money. I want you to understand the cycle, that way you can use it as an opportunity, because the reality is over the last 100 years, we have seen 16 recessions. We've also seen 25 stock market crashes, which is a bear market. A bear market, by the way, is when the stock market falls by 20% or more. We have seen many crashes, many recessions, and we're going to continue to see them happen in the future, and the same cycles happens every single time. I call it poop. Panic leads to overselling, leads to opportunity, leads to profit, because the financially savvy investors that use those downturns to buy when everybody else is selling can come in and buy great investments at a great price. So you have to remember that market cycles happen and stocks don't always go straight up, they go up over the long term. The second thing you want to remember is that you don't actually lose money unless you sell, or unless the stock goes bankrupt. So if you buy a stock for $100, it goes down to $50, you don't actually lose $50 unless you sell. And then if it goes back up to $200, you don't actually gain that $100 unless you sell. Keep that in mind because sometimes that psychology can entice you to make decisions that you're not ready to do. Number 3 is trying to time the market because the reality is no one knows what's going to happen tomorrow. Financial opinions are like armpits. Everybody's got a couple and some stink more than others. Everybody has an opinion, but no one has a crystal ball. Number 4 is ignoring your fees, your expense ratio as a passive investor. Those small little expense fees can add up to a huge cost over the long term. In fact, a 1% expense ratio can end up costing you more than a quarter, more than 25% of your total investment portfolio over the career of your investment journey. Why? Because it's a 1% fee that you don't just pay one time, you pay it on every dollar that you invest and every dollar of profits. So while your money's working to grow, your fees are also growing as well. Number 5 is YOLOing all in on one stock because yes, it can be fun to dump all of your money into a random stock you read about on Reddit, but if you don't know what you're doing, you're also taking on all the risk. And if you don't know what you're doing, you're really kind of just gambling. Mistake number 6 is investing more money than you're willing to lose because at the end of the day, you don't want to look at your stock brokerage account like a checking account. It is a long-term investment account. Think of that money as gone. Hopefully you're going to grow your money many times over, but if you need your stocks to pay your bills, you're doing it wrong. Take your extra money, invest that in stocks. Don't invest the money you need to pay your bills. And finally, the 7th mistake you want to avoid is being inconsistent. The reason why so many people lose money isn't because they made the wrong investments, it's because they didn't invest their money. And this is where you want to remember the way you build wealth is by sticking with it for the long term and sticking with it through the ups and downs. When you become inconsistent, you invest a little bit of money now, and then a couple of years later, you look back and say, oh, I wish I kept investing. You put some more money in now and next month, and then you forget about it, and then you look back at it 2 more years later. That strategy is a recipe for disaster. Stay consistent with what you do. Remember the principles, remember your strategy, and stay calm through the emotion. There's going to be a lot of craziness ahead. This is something that's been happening forever now. We're going to see ups, we're going to see downs, we're going to see booms, we're going to see crashes. But at the end of the day, your goal is just to work to keep accumulating more assets, to grow your wealth and grow your portfolio. And if you stick with it, you will surprise yourself because the more you do, the more you learn. Yes, mistakes will happen, but just stick with it. And hopefully my education here and my Market Briefs team, plus my Briefs Pro team, can help guide you along the way.
How do you think that institutions profit from our financial uneducation?
Well, I think the system, our economic system is designed to keep the majority of people poor. And our economic system is designed to profit off of when people are financially poor. Now, you might say, Jaspreet, you sound like a conspiracy theorist. Well, I'm not.